All right, let's get right into it. We're going to break down a really compelling and honestly pretty alarming argument about the silver market. This isn't just some far-off theory. No, this is presented as a mathematical trap and one with a very specific deadline.
So picture this. You wake up, you check the markets, and you see this number on your screen. $103 an ounce for silver. It hasn't just rallied, it has absolutely smashed through that triple-digit barrier. A price that, let's be honest, seemed pretty much impossible just a few months ago. The headlines are screaming, everyone's celebrating. But the source material we're looking at today asks a much, much darker question.
And what's really worth noting is that the source material places this event not in the past, but in the very near future. The argument they're making is that this isn't just some wild possibility, it's a rapidly approaching threat. Right, because here's the central argument. What if, for anyone with a retirement account, this massive celebration is actually a giant deception? What if the very system that's showing you this incredible price is actually designed to stop you from ever cashing in on it? So, this is where it gets really interesting. The core of this whole thing isn't about the price of silver itself, but what that price really represents. It all hinges on this huge and potentially dangerous gap between a promise on a piece of paper and actual physical metal that you can hold in your hand. You know, the truth is often hidden behind the numbers, and this is a perfect example. This slide makes a pretty startling claim that for every 100 ounces of silver promised on paper, only 11 physical ounces are actually sitting in a vault somewhere. Think about that. That's not just a small supply issue, it's a nearly 9-to-1 leverage of promises over cold, hard reality. And here it is. This is the mechanism of the trap. It's a clause buried deep in the fine print of so many account agreements, and it basically acts as a financial kill switch. When the physical metal is gone, your claim to that asset, well, it can be turned into a check at a price they determine, a price that might not even exist anymore in the real world.
So understanding this distinction is absolutely crucial. Let's really break down the difference between what a lot of people think they own versus what they can actually get their hands on when the system starts to creak and groan under pressure. And this, well, this slide just lays it out perfectly, doesn't it? On one side, you're basically an unsecured creditor. You're holding a promise from a big financial institution. But on the other side, you are a direct owner. You are in control of your asset. In a real crisis, the source argues, that difference isn't just a small detail, it's everything.
Okay, so this paper problem is one thing, but it becomes a full-blown emergency when a real-world event suddenly chokes off the physical supply. And according to the source we're looking at, a game-changing regulatory move has just done exactly that, permanently twisting the global flow of silver. Now, it's really worth paying attention to how much concentration there is in this market. A single country, China, doesn't just mine some silver. No, it refines and processes over half of the entire world's supply into the high-purity forms that all our modern industries desperately need. And this isn't some prediction of a trade war. It's referencing a new export licensing system that's presented as a total game changer. The source material argues it has effectively put up a silver iron curtain, just choking off the supply to the West. You know, if you're finding this kind of analysis insightful, please go ahead and like, share, and subscribe to our channel so you won't miss our future explainers. And the impact isn't theoretical. The source data shows an immediate and just catastrophic 82% collapse in the flow of physical silver from China to the West. And that's just in the first few weeks of this new system. We're talking about the main pipeline being completely severed. Now, what makes a supply shock like this so incredibly potent is that it's hitting a market that was already in a state of chronic shortage. I mean, this isn't a new problem. This is like pouring gasoline on a fire that's already been burning for years. Just look at the data from the Silver Institute. It shows that for 9 years in a row, the world has consumed more silver than it has mined. We've been systematically draining the world's above-ground stockpiles, which means there's no buffer, no cushion for a shock like this supposed export ban. And the demand is just accelerating relentlessly. It's really important to remember that this industrial silver isn't being stacked up in a vault somewhere. It is being consumed. It's permanently locked into the technology that powers our entire modern world. It is never, ever coming back to the market. So you see the squeeze, right? Both sides of the supply equation are failing. Primary mining output is actually falling, and recycling is becoming less and less effective because silver is used in such tiny amounts in our electronics that it's just not economical to recover it.
so the gap is getting wider from both ends. So all of this, the paper promises, the physical shortage, the supply shock, it all converges, according to the source, on one specific 52-hour window, a weekend. A weekend where the markets are closed, but the pressure builds to an absolutely unbearable level, exposing the system's greatest weaknesses.
I mean, just imagine for a second, you're a bank that has bet billions of dollars that the price of silver is going to fall. The market closes on Friday, and you are trapped. You can't get out. You can't cover your position. All you can do is sit there and watch the clock tick down to Sunday evening when the physical market in Asia opens up and reprices reality.
And the argument here is grounded in some pretty simple math. If you look at this table, even if the price of gold doesn't change one bit, a simple reversion of the gold-to-silver ratio back to a more normal, historical level implies a silver price way higher than that breakout point. The source argues this isn't speculation, it is just a mathematical reversion to the mean.
And this really highlights the core argument. The price you see on your screen is a lagging indicator. It's a relic. It reflects a paper market full of promises, while the real physical market where actual corporations are buying actual metal to build things is already trading at a massive premium.
And so the source material leaves us with this final, really provocative thought. When that paper price gaps up violently to finally catch up with physical reality, is your retirement account going to be holding a tangible asset or just an IOU from a system that can't deliver? The answer to that question, it argues, could literally define your financial future.